So now to our speakers. Professor Tim Congdon is an economist and businessman who has for over 40 years argued in the UK policy debate that banking and money can have powerful influences on macroeconomic outcomes. He's currently chairman of the Institute of International Monetary Research, which he founded in 2014 and is based at the University of Buckingham, where he's a professor of economics. His most influential position was as a member of the Treasury panel of independent forecasters, the so-called wise persons, between 92 and 97, which advised the Chancellor of the Exchequer on economic policy in a successful period for the UK economy. In June 2017, a collection of papers, Money in the Great Recession, edited by Professor Congdon, was published by Edward Elgar Publishing Limited. Dr. Juan Castañeda, who also joins us, has been the director of the IIMR since 2016. He joined the University of Buckingham as a lecturer in economics in 2012. He's worked with the European Parliament's Economic and Monetary Affairs Committee as an external report, and he's been an honorary senior visiting fellow at Cass Business School and a visiting researcher at the Center for Monetary and Financial Alternatives at the Cato Institute and at UFM University in Guatemala. He's authored and edited academic books and research articles on money, monetary policy, and central banking. And he's a review editor of the journal Economics Affairs and a member of the IA's Shadow Monetary Policy Committee. And Professor Geoffrey Wood is an emeritus professor of monetary economics at the University of Buckingham and has lectured in economics at the University of Warwick and in banking and finance at City University London. He's also worked at the Bank of England as an economist and later as special advisor on financial stability. He was also a visiting scholar at the Federal Bank of St. Louis, and he has also acted as an economic advisor to various firms and organizations, the New Zealand Treasury and the Bank of Finland. He's the author, co-author or editor of over 20 books on monetary policy and financial regulation, and has published over 50 papers in academic journals and appears regularly in the written and broadcast media. Gentlemen, thank you so much for joining us today. It's really a pleasure to host such eminent experts in this field. What I'll do at this stage now is hand over to Juan and Tim to start their presentation, and then after that, I'll ask Geoffrey for his response. Juan and Tim, over to you.
Well, Saeed, thank you very much for your kind invitation to participate in this webinar with my colleagues, with Geoffrey and Tim. May I first start by thanking the IA as well for giving us this opportunity to do a research on the impact of the policy responses given to the crisis in terms of prices, inflation over the medium to long term. Because of course, there are pretty much very urgent matters to deal with at the moment. But we should not disregard the effects over the medium to long term of all the policies we hear on a daily basis, how the central bank or central banks are reacting to the crisis. That will have an impact in the economy, and not just today or tomorrow, but over the next few years. And that's precisely what we deal with in this report. May I issue a kind warning first? We do monetary analysis in this report, and we do even dare to use the quantitative theory of money in explaining inflation. So why is that? This is not because we have any particular strict affiliation to the quantitative theory of money. It's because it works. It serves well in explaining inflationary trends in the medium to the long term, and that's precisely what we do in this report. So once we have now already just issued the warning, we can proceed with the content, if you don't mind. First of all, this crisis, the COVID-19 crisis, is very different to the previous major crises we have had in the past, especially the global financial crisis and the Great Depression. This crisis was originated on the supply side of the economy. It's a supply side crisis. Of course, it has ramifications and knock-on effects on demand as well, but it's very important to have the context, the theoretical context right. It started as a supply side crisis by governments mandating the lockdown of entire sectors, and some other sectors have been forced to work at very below full capacity for many weeks and months. This has produced already a collapse in production relative to existing demand, and that in itself is an inflationary trend in the market. But again, we should not deny that there are knock-on effects on demand too. We have some hard data about them, about these impacts too, but it's yet to know the real final impact on demand. So what should monetary policy do in this context?
Juan, we've lost your audio. Are you able to? Oh, perfect.
Is that all right now?
Yes, fine. Thank you.
Oh, sorry. What we should do from the monetary policy side in the face of a supply side crisis is to try to maintain a stable rate of growth of money. By money, I mean a measure of money that includes bank deposits, so that by maintaining monetary stability, we'll be able to maintain a sort of a steady rate of growth of spending, nominal spending along the cycle. That's the ideal benchmark. It's not only that this crisis has been quite different to the past two major crises, the Great Depression and the global financial crisis, but also the responses to the crisis have been rather different this time. So it's true that this time has been different. We have seen an unprecedented implementation in the question of days of stimulus packages to support the economy, both by governments, fiscal policy makers, and by central banks, the monetary policy makers. We've seen all across the world a surge in public spending in order to support households' incomes and companies, for sure. Just to give you an example, it is estimated that in the US, at least there will be a 15% deficit, 50%, sorry, of the GDP deficit by the federal government by the end of the year. That's quite a figure. That's unprecedented in peacetime, well, in modern times, for sure. Because that certain public spending is going to be paid by an increase in borrowing and in part by the monetization of this deficit. That will have an impact on the amount of money in circulation and in inflation. That's why it's so important. What about central banks? Well, they have showed that they have been much more ready and willing to support banks this time. So they have implemented new lending facilities, emergency lending facilities, again, in a matter of hours or days. And they have resumed asset purchases programs, QE, quantitative easing, to even to greater levels than those approved back in the global financial crisis. So the reaction of the central bank has been much more ready and generous as compared to 2008 and 9. And even more, something we should not disregard, rather than tightening bank regulation, as we did in 2000 and in the aftermath of the global financial crisis, now regulators have relaxed bank capital ratios. What this means is that all that money central banks are willing and are starting to put into the economy will be in the hands of banks and other financial intermediaries, and they will be in a better position to lend it out to the economy. That's a massive difference as compared to the aftermath of the global financial crisis. So basically, the context in which these reports assesses the reactions to the crisis is rather different to that in 2008 and 9. What we have seen all across the world is what we call fiscal dominance, which means central banks willing to accommodate their monetary policies, the amount of money in the economy, to the financial needs of governments by the partial monetization of the deficits. So that will have an impact, and it has already had an impact in money growth. That's something my colleague will elaborate further on, Tim Congdon. And let's check the figures for the US and for the UK and the Eurozone, and I'll pass it over to Tim, please.
Can we unmute Tim, please?
Hello, can you hear me?
Yeah, there's a lot of echo, Tim, but let's try speaking and see how it goes.
Well, I'm not sure I do much about the echo, but you can hear me all right, can you? All right. Well, in fact, in a way, it'll be the pictures that tell the story. So, well, first of all, just thank Syed for your introduction and the IEA for allowing us to give this presentation, and also just thank Juan for his remarks just now. The big message here to anybody who's looking in is there's been a dramatic acceleration in the growth of money in all of the major economies in the last few weeks and months, due essentially to the policy response to the coronavirus pandemic. And the result in particularly the United States has been a truly fantastic acceleration in money growth, so that in the year to May, the increase in the quantity of money on what we call the M3 measure, I've used it in my career over 40 years, and it's certainly the one that in my view always gives us an insight into the future. That's gone up by 25.5%. And annualized rate of increase in the last 3 months, almost 90%. And as I'll shortly argue, on all the history, as well as basic theory, this argues that there should be some inflation. And not just a little bit of inflation, like 2 or 3%, more like kind of say 5 to 10% at some point in the next 2 or 3 years, possibly even higher than that. Now, I'm not necessarily saying that what the Federal Reserve has done is wicked, but let's just be clear that if we move on to the next picture, that there's a lot of history that says that the increase in money, as on that M3 measure I just was talking about, and the increase in nominal GDP are related. It's a favorite theme, of course, of Milton Friedman and some other economists as well, maybe not a fashionable view at the moment, but there's the evidence. You can see over a period of about 100 years, correlation between the increase in broad money and increase in nominal GDP. And over the entire century, the increase in broad money was 6.6% on average, and the increase in nominal GDP was 6%. I just told you that the increase in the year to May was 25.5%. Does that mean the increase in US nominal GDP is going to go up to 25% or thereabouts? Well, not necessarily, but I think we have to be very concerned about what's been done. And so if we move on to the next picture, please, Juan. Sorry, this doesn't go out as well as it might have done. And I hope you can see it at the end. The current blip upwards in money growth is indeed to numbers last seen in the Second World War. Just how exceptional they are. Nothing like this in the post-war period, nothing quite as extreme as this. What I've done here, you possibly can't see it, but is I've just sort of extended it, taken it that there'll be now a slowdown, and then we can kind of compare the current episode with the past. And one can argue that it's what we're going through is a bit of a blip. And that things will return to normal quite soon, and so there won't be too much of a shock to activity, asset prices, inflation, and so on. Maybe. I don't know what's going to happen exactly in the next 6, 8, 10 quarters. I don't know exactly. Nobody does. It depends a bit on when a vaccine emerges, if a vaccine emerges, and so on. But you can see here, this is it's called a histogram. It shows the historical record of the changes in the velocity of money in the getting on for the last 60 years. Yes, there are some occasions when the velocity of money changes significantly. It goes up or down by 7, 8%. But there's been nothing quite like what happened in the year to the second quarter, or is happening the year to second quarter 2020, when it's pretty clear that nominal GDP is going to go down, and they've had a 25% rise in money. How is it all going to work out? What's likely is a few quarters of asset price inflation. There's been strong stock market recently, a weak dollar. And then when we come back 3, 4, 5 years from now, we'll see that in fact the increase in money has been reflected in a rise in inflation. There will have been a bit of a boom beforehand. And that is the message of history, and it's the message also of standard theory. Things in other countries aren't quite so extreme, but I have to bring attention, given the work that we do at the Institute, to the fantastic numbers going on in the United States. In the Eurozone, You can see this acceleration again in the last 3 months, annual rate up towards 10%, the 3-month annualized rate up almost 20%. Look at the UK, similar numbers. Also, by the way, we haven't here got Japan, but Japan's also had a long period of very low money growth in Japan, and then the lowest increases in nominal GDP of the G7, G20, and so on. But at the moment, the 3-month annualized in Japan is heading up also towards 10%. So all around the major countries, we're seeing an upturn in money growth, which signals a return of inflation. Thank you.
May I just finish with a short reminder on what the Institute does. My colleague Tim Congdon, he just mentioned some of the biggest economies, the performance in terms of money growth in the biggest economies in the world. But we have conducted a research to assess the correlation between the links between changes in money growth, as you can tell here in this chart, that's the golden line, and changes in nominal income. And as you can tell, in many countries, a wide range of countries, more than 20, that correlation holds over the medium to long term. So you have countries with quite stable rates of growth of money, such as Japan or Germany or the Eurozone, and an equally stable rate of growth of nominal GDP.
And low,
whereas on the other side, low, yeah, and very low and stable and moderate indeed. And on the other side of the spectrum, we have Turkey, Mexico, Russia, or Argentina, indeed with just the opposite results, with an unstable and high rates of growth of money, accompanied over the medium term by equally unstable and very high rates of growth of nominal GDP, inflation. So if you want to learn more about these subjects, you're more than welcome to visit our website. As I said before in my warning, we do monitor analysis. Our website is the Quantity Theory of Money, mvpt.org. And you can contact us, you can subscribe to our newsletter and our research, or just drop us an email. Thank you very much for your attention.
Well, thank you, Juan, and I'm very pleased that you managed to get to an advert for IIMR as well. It's something we encourage very much. So I'm very pleased that you're commercially minded, particularly at this time when we need to boost the economy. Now let's ask Jeffrey for his response. So Jeffrey, if you could unmute yourself, and I could ask Tim and Juan to mute themselves, and then we'll ask Jeffrey's response.
If I'm correct in thinking, I am already unmuted. Is that correct?
Yeah, you are unmuted. Yes.
Fine.
Thank you.
Well, the traditional function of a discussant on these occasions is to disagree with the paper. That makes things very difficult for me because I agree almost completely with this paper. And when I say almost, I mean simply I don't think enough emphasis has been given to 2 or 3 things. But let me start therefore by saying that I want to elaborate some points of theirs rather than disagree with them. And the first point I want to elaborate is one that's not come out in the presentation, but is in the written version of the paper. And I think it's rather important because in the written version of the paper, the authors say that central bank economists, and this is correct, focus on interest rates rather than on the quantity of money. That's absolutely correct as a description. Why they do this, I don't know, but I do know that it's exceedingly dangerous. In several recent comments written over the past few years, Charles Goodhart and I have pointed out that this, in fact, as interest rates get low, damages the profitability of traditional banking, borrowing and then lending on, so that the transmission mechanism of monetary policy is disrupted. So focusing on interest rates, as central bankers do indeed, is dangerous to the transmission of monetary policy, and means the building in shocks which, when the monetary policy suddenly feeds through, that they don't expect. That is the first, I think, misleading thing they do. Secondly, people also have been looking back to some extent at the last financial crisis and previous episodes, such as Juan mentions, the Great Depression. Well, that is extraordinarily misleading, exceptionally misleading in this circumstance, because as Juan and Tim mentioned in an excellent paper, this is really a very unusual kind of recession. It's one caused by the governments of countries saying, stop doing any work, stop producing things, stop supplying services. Now, when you get a sudden supply contraction to an economy, but you keep on trying to stimulate demand, which is what governments and central banks are doing, there's a great danger of stimulating inflation. And I think that's highly likely. And also focusing on these demand side recessions as guides to what's going to come, directs people away from some important episodes in history where there have been supply-side recessions. And now they're not recent, and they're not exactly analogous to what we have today. But the three episodes I have in mind are the Second World War, the First World War, and the Napoleonic Wars. They all were episodes when consumers and home economies in Britain, in France, indeed, I don't have the data on that to hand, in Britain and the United States, consumers at home were squeezed. They couldn't get goods as a consequence of rationing. What happens when the squeeze on consumption was ended? Well, the answer was that what happened was there was a sudden burst in the demand for consumption. People rushed out to buy things again, as the present Chancellor in Britain encouraged people to do. They rushed out to buy goods. We saw that after the Napoleonic Wars, we saw it after the First World War, and we saw it, albeit suppressed, after the Second World War. So that suggests to me that the evidence of history, as opposed to the evidence of our models looking at the wrong episodes, is that this recovery could be quite rapid. And that, I think, really makes the warning from Juan and Tim the more important. Because if the warning is rapid, there is very much less time for central banks to react to this recovery. And how should they react? Well, Tim mentioned in his excellent presentation that Milton Friedman had devoted some work to history. So, along with Anna Schwartz, the great Anna Schwartz, Friedman and Schwartz looked at very long runs of monetary history, both in Britain and in the United States and indeed elsewhere. And they found that money supply growth, of course, mattered, but it really mattered for inflation if it went on for a long time. And that, it seems to me, is the danger with the present circumstances. That the monetary authorities in the United States, in Britain and elsewhere, allow monetary growth to persist, and in doing so, allow it to lead to inflation. And of course, inflation is hard to squeeze out, not hard technically, but hard politically to squeeze out, and of course also hard socially, because reducing inflation, except in extraordinary circumstances, will reduce economic activity and cause unemployment. So the danger then, seems to me, is not that this inflation will not come. I think that will be a modest rise in inflation beyond doubt, but how big it is allowed to get, how slow central bankers are to react. And that, I think, we should have serious concerns, because if we listen to the words of central bankers, they are currently, it seems to me, still focused on dealing with what they're thinking of as a more or less conventional recession. That is a grave error, which could lead to the kinds of inflation that we last experienced in Britain, perhaps even in the Heath Barbour period. Accordingly, then, I think we should pay attention to the arguments and, equally importantly, to the evidence of this paper, and start thinking about reducing money growth quite soon. This, of course, will be carried out by central banks by varying interest rates. That's their operating procedure. But central banks, like everyone else, should not confuse the operating procedure with the objective of policy, which is what it indicated of policy, which is money growth. And they should be poised to reduce money growth quite rapidly, because if easing up of the economy is successfully accomplished, there could be a pretty rapid rebound in consumer demand. But it is, of course, always the qualification that the thing that was killing people in the Napoleonic Wars and the First and Second World Wars went away at the end of the war. How people will respond to the fading away rather than complete disappearance of this virus is far from clear, but the danger, I think, is very much on the upside. Accordingly, then, we have to watch out for inflation and respond to it rapidly. And on that note, I have complete agreement with Juan and Tim on my working clear.
Well, thank you very much, Jeffrey, and also thank you very much, Juan and Tim. If you could both unmute yourself now. What I will do is now we've got about half an hour, just under half an hour for questions, and I will go to the Q&A function and read out the questions. And what I'll do is I will change the order in which I ask you to respond. And if you feel, I'll give all three of you a chance to respond, but if you feel there's no need for you to respond, please pass it on, and that will allow more time for others to ask their questions. So the first question, top of the league as it was, is from Mike Stoyanov. And his question is, QE during the 2008 crisis didn't lead to inflation, but just to increase in asset prices. What makes you so sure that this time the increase in asset prices will translate to the wider economy? Why don't I give Tim the floor first on this one, and then I'll ask Juan and Jeffrey.
Well, I'm going to be a little bit naughty here and say what I myself said about the QE exercise. I said it would not lead to inflation. The reason for that was that I look at what's happening with the quantity of money. And the key theme of late 2008 and 2009, 2010 was that the banks were told to operate with higher capital ratios, which meant that they reduced their risk assets, which destroyed money. And the need for QE was to create money, and in fact, it was the state was creating money. And I actually supported and approved that and actually advocated it. I said it wouldn't lead to inflation because the attack on the banks, the demands that they have operate so much higher capital were very restrictive. And now, what's happening this time? This time, as Juan noticed, the capital regulations have been eased. I actually agree with that, but they've been eased. And if you look at the growth of money, whereas in 2009 and 2010, it was very, very low, at the moment it's exploding. So in all these situations, we must have a theory. We must apply our understanding of how quantity of money is determined. And then we must see what happens. The difference between a money supply growth rate in America for most of the last decade has been typically been about 4% a year. In the last few weeks and months, it's been running at 1% a week. And that's an utterly different situation.
Okay, Jeffrey, do you want to respond to that?
Not so much a response as to add that, as Tim mentioned, regulations were tightened in the financial crisis so that banks could not lend out this money. And it might be easier for clarity in general discussion, not just today, but in general, if we spoke about which measure of money we mean. Do we mean a broad measure of money, such as affects inflation, or do we mean a narrow measure that is controlled more or less by the central bank? It doesn't do much to the economy unless it's allowed to affect broad money. And tightening capital regulations did not prevented that happening.
Juan, would you want to add anything, or should I move on?
I just wanted to say something on the lines of Jeffrey's as well, and Tim already said something that I want to say. So yes, I don't want to sound too pedantic, but we need to make a distinction between an expansion of the central bank balance sheet. That's a very narrow definition of money, including the so-called monetary base, the deposits banks have in the central bank. And another definition of money is all the other means of payments we use in our day-to-day transactions. So deposits, bank deposits. What happened in 2007 and 8 and 9 as well is that, yes, central banks expanded the balance sheets, the narrow definition of money increased quite a lot, but there was not enough money in markets to spend. The situation we have now is just the opposite. We have an expansion in the monetary base, in the balance sheets of the central bank, but also in the liquidity, in the means of payments available in the economy, in the amount of money. That's why we believe that now it will be inflationary.
Well, thank you very much. If I could just ask the people watching today, the viewers, make sure you put your questions in the Q&A and not in the chat function, please. And secondly, we have about 17 questions left, which we're not obviously going to get through the next half an hour. So if you can help me to select the questions by going to the Q&A function and voting for which question you think merits being asked, and I'll ask the ones at the top of the league, as it were. So the next question is from James Wyatt, and I will start with you, Juan. How long do the panelists believe the collapse in velocity of money will offset the rise in money supply?
Oh, that's a key issue, because if money is a monetary phenomenon as it is, it has to do with the supply of money and the demand for money as well. So that's a really good one. I don't have the precise timing, the precise answer to the question. So whenever we go back to something closer to normal, this increase in the demand for money, this rush for liquidity will end. That could be a question of months. That could be when the new vaccine hopefully will be available. So it could be a question of months or quarters, but no more than that. And then afterwards, we will see that phenomenon that Jeffrey described before in the aftermath of the war, which is people rushing to spend. And especially companies and financial institutions, they will have an excess in cash in their portfolios, and they will be willing, they have already started to diversify that portfolio by buying financial assets and also real assets and expanding their plant, the machinery, and so on. So I'm afraid that I don't have the answers. The precise timing, that will depend on how quickly the economy will go back to normal and how quickly we have available a vaccine.
Can I come in here and
Yes.
just thank James very much for his question. I know James is interested in the real estate world, and what I would say on that front is that two main things. My experience, these kind of money supply blips can take up to 5 years to work their way fully. The bulk of the effect is in about 3 or 4 years. I forecast double-digit inflation because of the acceleration in money growth in early 1986 in Britain, when we had the Lawson boom. We did get double-digit inflation. 4 years later in 1990, people thought I was mad when I said that inflation would go double digits. It did. My guess is that we'll see, so that's the kind of time I think of, but we'll see another feature. We'll see asset price inflation before we see inflation in goods and services markets. And so at the moment, there's a lot of surprise about how strong the American stock market is. That strong American stock market reflects the buoyancy of money growth.
Yes. Jeffrey, do you want to add anything, or shall I move on?
A brief historical addition. Whenever we look at the history of money supply fluctuations, we see that in the short term, money velocity goes in the opposite direction, but then it picks up. So the money supply fluctuations eventually always feed through to prices. This has been true in every country that's been studied.
Okay, if I could just remind people who've tuned in today, viewers, if you could go to the Q&A function and help to vote for the questions, that will help me select the questions. We have 19 outstanding, and we're not going to get through those, obviously, in the next 20 odd minutes. Alberto Ruiz Hoeda, he says, to the best of my knowledge, the ECB is giving money to banks through the LTRO for them to purchase sovereign debt, not to lend to households and firms. This is one of the most insane monetary policy measures I've ever seen. How will this influence M2 and M3 in terms of money supply skyrocketing? Jeffrey, do you want to start off with that one?
I'd rather hand that over to Juan in the first instance. He's the ECB expert here.
Please do. Over to you, Juan, as the ECB expert.
All right, thank you very much. And thank you to Alberto as well for his question. Yeah, I mean, anytime the central bank is engaged with the banking sector in an asset purchase, it will be increasing the amount of bank reserves in the case of the commercial banks. Yeah, and if banks are going to use that money to buy government debt, what it's going to do in the end is to create more deposits, is to create more money for the government to spend. So that's going to affect the amount of money in the economy, a broader measure of money in the economy. So this is a sort of a mixed policy. It has also fiscal implication. That's what I called before the fiscal dominance aspect of monetary policy in our days. So is the European Central Bank, the monetary authority in the Eurozone, sort of accommodating monetary policy to the needs of the treasuries. There is no single treasury in the Eurozone in order to facilitate the selling of the debt of the country, so in the Eurozone. So in order to answer to the question, let me just be briefer. That will increase the amount of money in circulation if it is used to buy government debt of the member states in the Eurozone.
Okay, does either Tim or Jeffrey want to come in? Or
well, could I just say,
yes,
quickly say something here that this is a technical subject, but it's quite important to what matters is the quantity of money. The level of transactions in our economy is about 50 times GDP in the UK at least. Money goes round and round and round, okay? And it's in these transactions that asset prices are determined and that's spending on goods and services to determine and so on. One credit decision, whether a loan is the government rather than the private sector, is just one. That's only a very small, the actual transaction financed by credit is very small compared to this huge turnover of money. It's money that matters. That's a point that Milton Friedman and Anna Schwartz made many times in debates to James Taubin and others. So, can I also just say, yes, I mean, you may say it's a pretty wicked thing that the banks buy government debt. To be clear, governments pay for schools and hospitals. I mean, that's not really the point. The point is the effect on money, and at the moment, money growth around the world is accelerating.
Let me ask you a question about that, Tim. We see the Federal Reserve stopped publishing M3, whether it was 2005, 2006. You've stressed the importance of M3, and I know you can collect the data, and you have collected the data for your paper. Is that significant? The fact that the Fed should be do you think they should be collecting or publishing M3?
Well, I'm sure both Juan and Jeffrey would agree with me here that the Federal Reserve is, I'm afraid, this is incredible, sort of arrogant thing to say, but it's intellectual kind of anarchy. They've ditched the quantity theory of money. They don't use that at all. Despite all the historical evidence that put together by Jeffrey, among others, by Friedman and Schwartz, by all sorts of very distinguished people, they don't look at money. They have a theory that's basically all about the unemployment rate, labor market, new Keynesianism. A chap called Clarida, Professor Clarida, is the second in command at the Fed. He never looks at money. They are worried not about inflation at the moment, but about disinflation. And well, we'll see what happens. This is a fascinating moment, and it's obviously going to be the next 2 or 3 years, one of the most decisive and important debates in macroeconomics. And just say we're very grateful to the IEA for hosting it.
Thank you. Okay, let's move on to the next question. And if I can remind viewers to go into the Q&A function and vote, that will help me select the questions. Next question is from Cormac Lucy. Since the 1990s, every recession has been met by ever greater inflation of monetary supply and of central bank balance sheets. Can this process continue indefinitely? And if not, how might it end? Jeffrey, I'm going to try with you. I'm going to try you again. Are you willing to take this one on?
It can be. The process isn't inevitable. It's not automatic. It was consistently produced by central banks overreacting, and they were fooled last time round into thinking that money didn't matter for inflation because they prevented narrow money, leading in turn to an expansion of broad money by the restrictions on the banking system. So can it end? Well, the answer is yes, of course it can end, if it requires simply the understanding and will to stop it. Now, saying simply the understanding and will, you might think if you look at recent periods of history that central banks and governments always lack that understanding and will. In fact, the last 50 years or so have been really rather unusual in monetary history. Central banks have displayed the understanding and will. I think there's absolutely no reason why they shouldn't do it again. So certainly, yes, it can be stopped.
Juan or Tim, do you want to come in there?
Well, yeah, I mean, it can be stopped. I couldn't agree more with Jeffrey. It just requires the will from the policymaker, from the central bank, to stop these, for example, these massive asset purchases programs. That's as a starter. And also, just following up one of the comments made by Jeffrey in his remarks, yes, indeed, we need a persistence in money growth in order to have inflation. And that's something that we can anticipate. Obviously, we still have to wait for the figures in the next few months, precisely because what we call the monetization of enlarged public deficits. We are seeing this combination of an expansionary fiscal policy, treasuries are spending a lot of money to support the economy, as they say, and then being financed in part by central banks printing more money, as they say, creating more money, buying the debt of the government. And that's going to accelerate in the next few months. And may I say that also in a presidential election year in America, I don't really anticipate a very tough Fed on the president of the US. So I don't think that there is going to be the will to be tough on the monetary policy sides of policies, may I say.
Okay.
Can I just say something aside? If that's
yes, please do.
Milton Friedman advocated back in 1959 that the growth of the quantity of money, broadly defined, should run at around about 4, maybe 5% a year without much variation. That was his key prescription for maintaining macroeconomic stability, low inflation, steady growth. Now, the Fed didn't do that for decades that followed. But then, amazingly, they did do this for 8 years, from the end basically of about 2010, early 2011, through to 2018. They didn't say they were doing this. They weren't following Friedman's prescription, but kind of by accident, I'm sorry about the phone in the background, by accident, they did actually manage to get inflation that keep this very stable growth of money. What then happened to the American economy was that the growth of nominal GDP was also about 4%, 5% a year. Inflation was very low. The economy was very stable. It all worked. Yes, they can do that again. They can do it again. It's not difficult.
Well, thank you, Tim.
The problem is intellectual. It's very much with our profession, economists. You know, we are a minority of the profession.
Yeah. Thanks, Tim. Let's move on to the next question. I see someone's answered the phone, Tim. Let's hope it's the Chancellor asking for your advice. Next question, or who knows, the US Treasury Secretary even. Pedro Schwartz asks, inflation is stable in the US and falling in the UK. When do you think inflation may start to go up? Tim, why don't you start off on that one?
Well, the oil price has actually increased in the last few weeks, so I suspect we'll see that's just an erratic movement. My guess is that we're going to need there'll be, at the moment, there's quite a big inventory rundown going on in the consumer sector around the main countries. And in fact, I suspect by the end of the year, we'll be seeing a bit of inflation coming through, even at the retail level. Okay,
Juan and Jeffrey, do you want to offer your...
We're seeing inflation, by the way, in assets already. Curiously, yeah.
Jeffrey?
Well, I think it could well come fairly soon, simply because these inflation numbers we see are partly contaminated by measurement error and measurement distortion. Just the day before yesterday, I think it was, the inflation figures came out in the UK, and the Office for National Statistics, the ONS, reported then that its sampling basis was much less reliable than usual. So these numbers should not be really greatly relied on and regarded as closely comparable with previous data. So I think the drop we have seen is undoubtedly in part, not so much measurement error as measurement distortion. And the numbers will pick up partly for the reasons Tim said.
And Juan, do you want to offer a thought?
Yes, very briefly. Yeah, I agree with my colleagues. And may I just say that we should concentrate on trends in prices, which are much more connected to changes in the amount of money issued now at present time. So that trend is going to be on the rise for sure. When, again, that depends very much on how easy it's going for economic agents, for households and companies to start going back to a much more normal scenario.
Great. Well, listen, we have about 10 minutes left and we've got about 20 questions. We're clearly not going to get through all those. So once again, a request of viewers, if you can go to the Q&A function and vote for questions, that will help me choose them. The next question is by Aladapo Sonugo. I apologize if I've mispronounced that. We have seen a significant rise in asset prices lately, especially in the equities market. Should we be worried about a repeat of the doom loop of government and banks' debt like the 2007 crisis? Juan, I'll give that one to you first.
Well, if it's the Oladapo that I know, it's one of our students at the University of Buckingham. So thank you, Oladapo, for your question. Yes, we certainly see this connection between the increase in the amount of money in the market and the increase in asset prices in recent weeks. We are already back on a level that is very much similar to the pre-crisis level in equity prices. And this is very much connected to the increase in the amount of money in circulation. So yes, whenever we have this major volatility and an increase in the amount of money in circulation, we're going to see, of course, equally important non-negligible changes in equity prices as well. Yes, even ahead of changes in CPI prices.
Tim, do you want to have a go at that?
No, Juan's answered that very nicely. That's fine.
Great. Jeffrey?
I've never any wish to comment on equity prices.
Fair enough.
If I had, I'd make some money.
Can I just say one thing, which is quite important, is that I, in my last monthly video for the Institute, I pointed out that in the USA, where we've got plenty of good data, the increase in the quantity of money as a whole since the end of 2018 or the end of 2019 would be, say, around about 25–30%, something, say 30%. The increase in the quantity of money held by the financial institutions the pension funds, the insurance companies, the mutual funds that buy stocks and shares, probably more like 50–60%. And that, just by the way, last week, figures came out from the Fed that confirmed my conjecture about this. It's a typical pattern. When you get accelerations in money growth for the whole economy, you see faster accelerations in the growth money holdings of the financial sector, which then affects equity markets and so on. And we are seeing that at the moment. Equity markets have been surprisingly resilient given the news, but in fact, most financial institutions are holding higher cash to asset values than normal. When the world returns to normal, I suggest the cash ratios go back to normal, jump in asset prices.
I wonder if I could ask either Juan or Tim to post a link to your last video in the chat function while I ask the next question. Next question is from Gabriel Fagan. Are we dealing with a one-off, albeit big, rise in the price level rather than a protracted rise in inflation? Jeffrey.
Well, that depends, of course, entirely on how central banks behave. If central banks stop this monetary expansion, then at worst we'll have a rise in one-off, quite large rise in the price level. It might not be all that large if it's stopped now. If they continue for a longer period, then we'll have protracted inflation. And my anxiety is that it will continue for longer, simply because it's difficult to reduce money growth, not economically or politically. They feel they have to keep on stimulating the economy to ensure there's no deep recession. So the risks are political and, if you like, social. They're certainly not economic. It could be dealt with quickly.
Right, and thank you to Gail and Juan for posting in the chat function the link to Tim's latest video. With that, Tim, I'll come to you. Do you want to answer that question?
No, I think Jeffrey's done very well. That's okay. Fine.
And Juan, do you want to add anything?
No, it's fine. Perfectly
great,
fine.
Great. So next question from Philip Wollstonecroft. If money growth comes back down to 4 to 6%, what needs to happen to fiscal policy? Tim.
That's a very good question. What's happened in the last 3 months, Philip, is that the US budget deficit in that 3-month period has been about $2.5 trillion. And that has been financed almost entirely at the short end. Now, amazing numbers. Now, it won't run at that continuing, 2.5 kind of trillion, 800 billion a month number. But it's going to be higher than before. Essentially, to get the numbers in monetary control back, they've got to reduce the budget deficit to more normal levels and also fund the deficit at long end by sales of long debt, notes of 5 years and bonds of 10 years and plus and so on. Well, maybe they will, but I think what many of us feel, including the panelists here, is that in a presidential election year, it's going to be difficult for the presidential team, the administration, and the Fed, I'm afraid, to really get these things back under control. So it's all too plausible that we'll have continued rather high money growth in the next few months. Yes, then I hope we do return to more like 0.5% a month. But we don't know. And what is depressing is the central banks just aren't talking in this, my kind of language, monetary control, that they were, say, 30, 40 years ago, even 5 or 10 years ago. They seem to have gone into a different kind of, it's an amazing kind of, astonishing what's happening at the moment.
Jeffrey or Juan, would you like to come in?
Well, in the UK, the situation really is quite interesting because Britain has had very big debt to GNP ratios in the past. And they don't require a drastic response, provided you stop adding to the debt. The debt can then be run off very slowly over a period of years. The classic episode when that was done was, of course, at the end of the Napoleonic Wars, when simply the government stopped fighting the war, its current expenditure dropped sharply, and the result was that debt was paid off and fell relative to GNP very slowly. The same could be done again. All it requires is the willingness to stop all these subsidy schemes. And if it stops that, it will be good, not just for long-term inflation prospects, but also good for the efficiency of the economy. But it will stop distorting the economy and preserving firms that perhaps should go out of business to create space for more enterprising ones.
And Juan, anything to add?
Yeah, something very brief. Do you mind if I share the screen again?
Yeah, please do.
Yeah, it's just to go back to this slide that Tim presented before. I mean, this period that I'm over, this period from 2011 to 2019, is a period of macroeconomic instability. As Tim put it, it's a period in which money grew at a fairly stable rate, 4-5%, compatible with sustainable growth in the economy and price stability. This massive spike in the lines, this is not sustainable over the long term. So of course we will have to go back to something more normal, but that will imply stopping this fiscal dominance phenomenon that I mentioned before, this monetization of the deficit, and much more fiscal discipline. It will have to happen at some point, maybe by the end of the year or well into 2021.
Well, thank you. We've got about 5 minutes left. Probably got time for one last question. With apologies to James Wyatt. Since you've already asked a question, James, I hope you won't be offended that I'm going to pass baton to someone else. Andrew Dowie asks, will the Fed be ordered to cap the yield on the US 10-year note and 30-year long bond next year, given the outlook for inflation? Given that this is your last answer, I'm going to go Jeffrey, Juan, then Tim, and please feel free to add up any summing up comments that you want to make as well. So Jeffrey, an answer to Andrew's question.
It reminds me, I suppose, of Shakespeare of Henry IV, Part 1, I think, when one chap says to the other, I can call spirits from the vasty deep. And the other says, and so can I, but will they come when you do call on them? The Fed cannot control these yields at all. It can't peg them and say, this has to be the price. It could only do that by pumping money into the system or withdrawing money from the system. As it goes further out the yield curve, the quantities would have to be absolutely enormous. So the Fed could be ordered to do that, but the Fed would have no way whatsoever of carrying out its orders.
Juan?
I agree with Jeffrey, but I will leave it for Tim to elaborate further, if you don't mind, Said.
Yes, please do. Thank you.
That was this question is very realist, very important question. We had, after the Second World War, rapid money growth in the USA and inflation problem, and the Federal Reserve had to reach an agreement with the Treasury, the so-called accord, in which the Fed was free to manage the public debt as it wanted to for monetary control purposes, so that it did not have to fix yields to help the Treasury. They had a big row about it, and in the end, the Fed said, we can only control inflation if you leave us alone to do the job properly. Now, I don't know what's going to happen here. The talk is that they're still worried about disinflation, and the talk is they're going to control yields, but not at 10 years or 30 years. So, Andrew, so we'll see what happens there. Can I just say finally on this front that this is what's going on at the moment is not at all like the Great Depression. In the Great Depression in America, the quantity of money fell by 1% a month. Did that for about 3 or 4 years, and that's what caused the Great Depression, made it so bad, and the rest of it. In the last few weeks, the quantity of money has been rising by 1% a week. That is the difference between, and the way in which some newspapers and commentators talking about the Great Depression is completely misplaced. Thank you.
Well, Tim, Jeffrey, and Juan, thank you very much for joining us today. I think it's been absolutely fascinating. I also like to thank everyone who tuned in today, who joined us online. I apologize that we didn't get through all the questions, but you can see how much interest the discussion generated, the fact that there were still 17 unanswered questions, and in mastermind fashion, the team had managed to get through 8 questions. So a lot of interest there. I wonder whether the guests, Juan, Jeffrey, and Tim would mind if anyone particularly wanted a question answered, whether they could email you or contact you if they've got any outstanding questions.
Pleased to help, yeah.
Please do continue the conversation. It's absolutely right that we are having these sort of conversations.